Most trading losses do not come from bad strategies. They come from decisions made without structure. Trading without a plan does not always look reckless. Sometimes it looks confident, sometimes it looks intuitive, and sometimes it looks like experience. But in reality, trading without a plan is trading without boundaries. A plan is not just a set of rules. It is a decision-making framework created before money is at risk, and that timing matters. Welcome to the Phantom Trader world, where clarity comes before execution. When you enter a trade without a plan, you are outsourcing decisions to emotion. Not because you want to, but because pressure forces it. Once money is on the line, the brain changes behavior. Fear appears faster, hope becomes louder, and logic becomes flexible. This is why traders who enter trades feeling good about it often freeze when price moves against them. They don't know where they are wrong. They don't know when to exit. They don't know how much pain is acceptable. So they wait. They hope. And hope is not a strategy. A trading plan answers 3 questions clearly. Why am I entering this trade? Where am I wrong? What will I do if price moves against me? Without answers to these questions, every movement becomes a debate, and debates during live trades always favor emotion. One of the most common behaviors of traders without a plan is holding losses longer than intended. They do not close the trade because closing feels like admitting failure. So they delay, they rationalize, they wait for the market to come back. But markets do not rescue poor decisions. They only reveal them. A plan removes negotiation. It turns decisions into execution. Another problem with trading without a plan is inconsistency. A trader may exit early one day, hold losses another day, and double down the next. Not because conditions changed, but because emotions did. Without a plan, there is no reference point. You cannot measure discipline. You cannot evaluate performance. And you cannot improve. This is why journaling without a plan is useless. You are recording chaos. Professional traders understand this deeply. They do not rely on how they feel during a trade. They rely on decisions made before the trade exists. Their plan defines risk per trade, maximum loss per day, conditions that invalidate the idea, conditions that justify staying. This does not make them rigid. It makes them protected. Many beginners avoid planning because it feels restrictive. They believe plans limit opportunity. In reality, plans limit damage. A plan does not guarantee profit. It guarantees survival. And survival is the first requirement for learning. Another misconception is that plans remove flexibility. They don't. Good plans adapt before execution, not during panic. A professional may reduce position size or skip a trade entirely when conditions are unclear. That is flexibility. Changing rules mid-trade is not flexibility. It is reaction. Trading without a plan also creates false confidence. A few wins achieved randomly can feel like proof of skill, but randomness always collects its debt. Eventually, one uncontrolled loss erases multiple small gains. This is why traders often say, "I was doing fine until one trade." That one trade was never the problem. The absence of a plan was. Plans also separate identity from outcome. When you follow a plan and lose, you did not fail. The system experienced variance. When you break a plan and lose, you damage trust in yourself. That damage is hard to repair. Over time, traders without plans lose confidence not in the market, but in their own decisions. And once confidence is gone, execution collapses. Trading is not about being right. It is about being consistent. A plan is the tool that makes consistency possible. It defines behavior when emotions try to interfere. So when traders ask why they are not improving, the answer is often simple. They are trading situations, not systems. And without a plan, there is no system to refine. Trading without a plan is not freedom. It is exposure. And exposure without protection always ends the same way. Let's define what a plan actually looks like, because many traders think a plan means I will buy here and sell there. That is not a plan. That is a guess with extra confidence. A real trading plan has layers. Layer 1, your environment. What markets do you trade? What time frames do you use? What times of day do you trade? And equally important, what do you avoid? If you trade everything, you are planning nothing. Layer 2, your setups. What exact conditions must exist for you to enter? Not I feel like it's going up, but a clear checklist you can repeat. Layer 3, your risk rules. How much do you risk per trade? What is your maximum loss per day? What is your maximum number of trades? When do you stop trading even if you want one more? Layer 4, your execution rules. Where is entry? Where is invalidation? How do you manage the trade? Do you take partial profits or not? Do you move stops or not? not? Under what condition is an exit allowed? Layer 5. Your review rules. How will you journal? How often will you review? What metrics matter? Rule following rate, average risk, drawdown, overtrading frequency. Without review, your plan is just theory. Now, why does this matter so much? Because markets are not dangerous only because price moves. Markets are dangerous because they invite you to improvise. Every candle whispers, maybe this time is different. Maybe you should exit early. Maybe you should add to the position. Maybe you should ignore your stop. A plan is what protects you from that conversation. Now let's take a real example. A trader enters a trade without a plan. Price moves slightly against them. They feel discomfort. They don't close because they might be right. They wait, then the loss grows. Now closing feels worse, so they wait more. Eventually, the loss becomes large enough that they either panic and close at the worst point, or they hold and hope for a miracle. In both cases, the trader is not trading the market. They are trading their own emotions. A planned trade looks different. Before entry, the trader decides, if price hits this level, I am wrong. They accept the loss in advance. So when price hits that level, there is no debate. They exit, they record it, they move on. Same market, different experience. That difference is the plan. Now here is a simple plan template you can write on one page. 1. Market focus. I trade this market on this time frame. I avoid trading during these conditions or time. 2. Setup rules. I enter only when condition A, condition B, and condition C have been achieved. 3. Risk rules. Risks % max loss per day, X% max trades per day, X trades. If I hit the daily limit, I stop. No exceptions. 4. Execution rules. Entry condition is, then write your condition. Invalidation level is this. Target approach is that. Trade management rules are 1, 2, 3, etc. 5. Review rules. After each session I record, did I follow rules? Yes/no. What mistake happened? What will I improve tomorrow? This is not complicated. It is clear. And clarity is what removes emotion. Now, a common objection is, but what if I miss opportunities? A plan is not meant to catch everything. It is meant to protect you from everything. Missing a trade is not damage. Breaking your rules is damage. Another objection is, but I want to be flexible. Flexibility is good, but it must be planned flexibility. For example, I reduce position size during high volatility. That is flexibility. I moved the stop because I felt nervous. That is reaction. Professionals are flexible before execution, not during fear. And finally, planning builds trust. When you follow your plan and lose, you still trust yourself because you did what you said you would do. When you break your plan and win, you lose trust anyway because you trained yourself to be random. Over time, randomness destroys confidence, and confidence destroys execution. So the plan is not just for profits. It is for identity. It teaches you to be consistent. And in trading, consistency is the real edge. One last point, your first plan will not be perfect. It is not supposed to be. A plan is a living document. You start simple, you execute, you review, then you adjust based on evidence, not based on mood. If you change rules every time you feel pain, you are not improving. You are escaping. So build a plan that you can actually follow. Then let time and repetition refine it. That is how traders grow from guessing into operating, because a plan reduces cognitive load. Decisions are already made. Your mind is free to execute calmly. And calm execution is what makes probability usable. Without a plan, trading is a conversation with fear. With a plan, trading becomes a process. And process is what survives pressure. That is the difference. And it changes everything. If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.